Today, we'll learn different smart money concepts: failed to return, indecision candle, and the first time back. This will be a technical video of explaining the importance of using stop-loss orders and how to use the back holder's emotional state to our advantage. How we can do day trading or even scalping from certain supply and demand zones. If you're ready, let's start. Welcome our free trading course. My main aim is to teach you price action trading strategies and smart money concepts. If you enjoy scalping and day trading or even swing trading, you are in the right place. Check out my free trading course. You can find the links on Google Drive or directly from my website, which is in the description. Okay, let's talk about one of the most common trading concepts in smart money trading, the FTR, failed to return. Actually, FTR is a form of a rally-based rally or drop-based drop, but with a much more specific approach. When you see a really fast rise in an asset with a quick stop, then another fast rise, we call this quick stop area FTR. But how to determine the exact FTR? Let's see this example. Price sharply rises, all green candlesticks, a momentary stop, a single red candlestick, then another rally upwards. Now this single candlestick is called the exact FTR, failed to return area. It is also called IC, indecision candlestick. Many sources on the internet consider FTR or IC area as one single candlestick. However, in my opinion, any amount of consecutive opposite color candlesticks determines the fail to return zone. Let's see the bearish FTR or indecision candlestick. Exactly the same concept. Price sharply falls and it makes a quick stop, then it falls back again. This will be our FTR zone. Let's see this example. Price falls very sharply, most of the time leaving imbalanced candlesticks behind. And a sudden stop, green candlestick. This green candlestick is called failed to return FTR or indecision candlestick, the IC. Do not focus on the names, everybody gives a different name to this. I'll explain the logic of this idea soon. Now let's do one more example. Price falls sharply and then makes a quick stop with 3 green candlesticks in a row, and then falls again. This is my FTR zone, a very important supply area in my mind. Let's understand the reasoning and the logic of the FTR and IC candlesticks. First of all, I personally call FTR as back holders or falling knife catchers. If you do not know what a back holder is, it's just an investor or swing trader without stop loss who tries to keep buying dropping stocks or any other assets without reasoning. Let's understand the concept step by step. Assuming that Tesla was pricing at $400, many investors and swing traders love Tesla. Once the price sharply falls, many traders and investors will look for indicators like RSI oversold, stochastic oversold, EMA or SMA touch, support and resistance, anything you may think of. Then they will start to buy it. Investors will try to hold for the long term. And many swing traders will enter a position, and most retail traders never use stop-loss orders. At this point, everything is just fine. Because stock may rally from this point, we have no idea about it, but it is possible. What we focus on is if the stock falls again sharply. As you can see, it falls. Now, every investor and swing trader without stop-loss, inside these 3 green candlesticks are now back holders, holding an asset that keeps falling. Now I want you to imagine this. We all did this. I did this 100 times possibly. When you start to wait in a losing position for a long time, it causes emotional damage to our brain. So the moment at break-even, we want to exit it and save our money. It is a genetic instinct. This is called FTB, the first time back. The moment all these backholder investors and swing traders without stop loss will want to exit the trade. They need emotional relief after holding a losing position for hours, days, or weeks. Now at this point, we look for trades. We go deeper and deeper to find entry points. Now, let's check this Tesla chart and try to identify the back holders and how they bailed out at break-even when they got the chance. I want you to look for this area. Very sharp fall, then 3 green candlesticks in a row. Now at this point, we have no idea if they will be back holders or not. Tesla could have gone to $1,000 from this point. We do not know and we do not care. Price action is all about what happened previously, not what is going to happen next. Now after that, price falls again so sharply. At this moment, we know that there are back holders right here. These people now wait at negative 37%. If you look at the period, it is 88 days. Imagine you are waiting in a negative position for 88 days. Emotional damage. What will happen next? They will want to exit most of their positions at break-even. As you can see, there is a big sale from the FTR, and many people exit here, causing more fear and panic to boost more sales. But again, some people enter right here. Tesla pricing at $300 and it may go over $1,000 from this point. One more time, they could have been right. We do not know at this point, but the price falls again. Now we know something. People become back holders right here. You see, price action is all about previous facts, not predictions or guessing. This is a side effect of not using stop-loss orders. If you do not use stop-loss orders, and unless you are not a 2 or 3 years long investor, you could be a back holder any moment. These people now wait at negative 36%. If you look at the period, it is 140 days. Another emotional damage. This is why you must use stop-loss orders. And the same thing keeps happening again and again. Now, how to trade with FTR? First of all, in my opinion, FTR should be identified in higher time frames as a zone. We most likely try to catch the moves of investors or swing traders. FTR in 1 minute may not work well. This is not a rule, of course, just a suggestion. The easiest way to use FTR is ranges or classic premium discount areas without ranges. Once you identify your premium and discount zone, when the price is expensive, you may try to catch the back holders by identifying the fail to return zone. Then you'll wait for the first time back FTB and look for a suitable entry. Or you can use the discount areas to catch the short sellers. Just identify the FTR area as a general zone and wait for them to cover their losing positions by finding a suitable entry. Another common way is identifying SR flip zones or breaker block areas. It is all the same concept actually. What we do, our logic is so simple. We try to catch the movements of losing traders without stop loss and backholders. We know their emotional state and the urge of closing their positions at break even, and we use it to our advantage to enter a position. In the coming weeks, I'll work on many trading examples of this, but I think you got the basic idea. Okay folks, I think this video is great for understanding how the back holders are created and how badly they want to escape from their losing positions. I'll cover more and more examples in the future. You can use these strategies with Forex, crypto or stocks or anything that you want. I hope you subscribe to the channel and like the video. Thank you, please take care and see you soon.